An important purpose of accounting is to measure and report a business's profitability. To the extent of the reported profit or loss, it will communicate the success or failure of a business with regard to the company's goal of profitability. In this chapter, we will look at how businesses measure business income as it relates specifically to their goal of profitability. The goals of Chapter 3 are to, first, spend a little time defining net income and its two major components, explain the difficulties or challenges that businesses have in the income measurement process that are caused by the accounting period issue, continuity issue, and the matching issue. Then we will focus on explaining accrual accounting and the two broad ways that accrual accounting is accomplished. We will explain the four principal situations requiring adjusting entries. We will show or demonstrate typical adjusting entries. And then, lastly, we'll talk about the financial statements that are prepared after the adjusted trial balance is completed. So our first objective is to explain net income and the two primary components of net income. Two goals of business, as mentioned in Chapter 1, are profitability and liquidity. In this chapter, we will be focusing on the profitability goal. It is what really communicates the apparent success or failure of a business. To survive, a business must earn a profit. Profit, though, may be, as a word, ambiguous, because lay people often think of profits as cash or increases in stock. Neither of those two situations are true. Net income is the preferred word or term to be used when we're describing a company's or business's profitability. Net income is more specific. It can only be specifically defined as either when we have revenues greater than expenses or when we have revenues less than expenses. Obviously, businesses want to ensure that their revenues are greater than expenses. This will cause it to earn a net income. A revenues less than expenses will cause a business to report a net loss. The two components of net income, revenue and expenses, we will explain in a little bit more detail. Revenues are simply increases in the stockholders' equity due to selling goods or services that are normal activities of a business, not including such things as selling businesses' equipment or things that are on their balance sheet that are not in their normal course of operations to be sold. Not all transactions also that are for cash are going to increase revenues. Examples: a bank loan. That would not be an example of a revenue. It is not used to produce revenues. Collection of accounts receivable. Those are also not revenues. The revenue in that situation was earned when the sale was made on account. We cannot, at the time when we collect the account receivable, count that as revenues, because it would be double counting the same sale. Thirdly, investments by stockholders. When we receive an investment in the business by stockholders and we receive cash into the business at that time, that would not be revenues. It does not generate revenues for the business. It just simply generates additional cash and equity. The second component of net income are expenses. Expenses decrease the stockholders' equity, and they result from activities that the business is doing to earn revenues. The cost of selling products or services is said to be spending money to make money. It is what we call the cost of doing business. The cost of activities necessary to carry on the business's operations and the cost of attracting and serving customers. These are things such as salaries, rent, utilities, depreciation. These are all things that would be considered normal expenses of a business. And again, just like with revenues, we said not all cash is revenues, not all cash payments are expenses. For instance, the repayment of a loan, that would not be considered an expense, nor would a decrease in the stockholders' equity associated with dividends. That would not be considered an expense. Sometimes, however, there may be a two-step process to incurring an expense. For instance, and we've learned about this first one in the past. If you recall, in the past we've talked about prepaid items. For instance, prepaid rent or prepaid insurance. You create a prepaid asset at the time that you pay cash for that asset. And then as you use up that asset or expire it, little by little, you allocate that asset to an expense at the time that that is used up or incurred. So for instance, if I were to say I paid my 6 months rent in advance, at the time I paid for the rent, the 6 months of rent, I would debit prepaid rent and I would credit cash. Each month, as I use up that rent by operating in that facility, I will then debit my rent expense to reflect the rent has been incurred. I will debit my rent expense and then I will credit my prepaid rent for a similar amount or for an equal amount to reflect that I've used up that small portion of the asset. Secondly, we also have things such as plant assets, buildings, equipment, trucks, etc. When we purchase these, whether we purchase them for cash or borrow money, we put them on the balance sheet as an asset. So we would debit the building or we would debit the equipment and then we would credit either cash or a loan. Over time, as the value of the building or the truck goes down or depreciates, we must allocate a portion of that asset to each accounting period in which that portion is used up, or what we call expired. In this regard, we sometimes say that expenses of a business are the expired costs of the business's resources or its assets. So, at the end of this section, let's ask ourselves the question, why does the accountant use the term net income instead of profit to help determine or explain how the business is performing for profitability purposes? Let's move on to our next objective for this chapter. Objective 2A is to explain one of the difficulties associated with income measurement. This difficulty is the accounting period issue. The first issue that businesses have with measuring income has to do with assigning revenues and expenses in the appropriate periods. The difficulty of assigning revenues and expenses to a specific period, month, quarter, or year has to do with the fact that not all transactions can be easily assigned. So for instance, let's say you have the purchase of a building or equipment. These items will be used for many periods, maybe even many years. So the question comes up, how do you allocate the expense or cost of that item over multiple periods. Another issue is when you have sales of items that take place over time, such as the construction of a road or the creation of customized software. So the issue becomes that many transactions span multiple accounting periods, and accountants must apply a measurement between periods, but these measurements are only estimates for allocation and recording of revenue and expenses purposes. Accountants must make estimates or assumptions and then consistently apply these assumptions from year to year or period to period. That's where the periodicity principle comes into place. The periodicity principle says that businesses must make assumptions about the period of time for their accounting measurement and measure their net income for that period of time consistently from year to year. So they must have periods of equal length, and the 12-month accounting period is the fiscal year, and it corresponds typically to a business's yearly cycle of business activity. Fiscal periods do not have to correspond to the calendar year activity. They can be any 12-month period. They're typically determined by whatever meets the best needs of the business. And you can see an example on an example chart on page 135 of the different fiscal periods for various businesses. The time period or fiscal period for every business is typically explained in the financial statements, the footnotes to the financial statements. Periods less than a full year are called interim periods, and businesses typically measure their interim periods in monthly, quarterly, and semi-annual increments. The next objective in this chapter is to explain the difficulties of income measurement that are caused by the continuity issue. As we explained in previous slides, the measurement of business income requires that often certain expenses and revenues be allocated over several accounting periods. The continuity issue relates to the estimated number of accounting periods in the business entity's life. Accountants must assume that a business will continue to operate indefinitely unless there is evidence to the contrary. So basically, an accountant assumes that an entity will be a going concern and that that entity will continue indefinitely unless they have reasons to believe otherwise. If a firm is not considered a going concern, financial statements may be prepared on the basis of a liquidation value of the assets rather than what their actual values should be. The reason that businesses would do that, report at a liquidation value, is because they're going to try to make assumptions about how much cash would be brought in as they liquidate that business. Obviously, businesses do not want to be listed as having a going concern issue. Businesses want to be considered to have a going concern, meaning that they are going to continue indefinitely. Next, let's discuss the difficulties of income measurement caused by the matching issue. Let's look at the matching issue and what it is. Many small businesses use what we call a cash basis accounting. They report their revenues and expenses when cash is either received or paid. That means that revenues are only recorded when cash is received. So, if we sell something for cash, that's the only time that we would record a revenue. Additionally,